Hello everyone, welcome to Tech Time with Bing Dai. In today's episode, I would like to talk about angel investors. This episode is for people who may want to become an angel investor one day, and for people who may want to raise money from angel investors one day. First of all, what is an angel investor? There's actually no strict definition of the term angel investor. So an angel investor is loosely defined as an individual who provides money to fund early-stage startups in exchange for some equity or share of ownership in the company. An interesting fact about angel investor is that the term originated in Broadway. It was used to describe wealthy patrons who fund the production of new theater shows. And these days, angel investors fund small companies. So an angel investor can be anything ranging from an entrepreneur's family members or friends who want to support the entrepreneur to affluent business professionals who want to invest in small startups. Business professionals have several reasons to become angel investors. One obvious reason is for the potentially high financial return. However, being an active angel investor is also a great way for these professionals to stay connected to their industry and build potentially very beneficial business relationships. It is also a great way for them to nurture the next generation of entrepreneurs. Speaking from entrepreneurs' point of view, what qualities would you want to have from your angel investors? Who would make an ideal angel investor? In my opinion, the best angel investors are entrepreneurs who have successfully built a company in the field that your company is in. These entrepreneurs turned investors can be great angel investors because other than being able to provide the funding, they can also mentor you on how to handle challenges when you're building a company in the field. A great example would be the first major angel investor of Google, whose name is Andy Bechtolsheim. Andy Bechtolsheim himself was the co-founder of Sun Microsystems, which at its peak was one of the largest computer companies in the world. So Andy Bechtolsheim provided the very young Google co-founders of that time with not only the $100,000 of investment that they desperately need, but also in-depth knowledge of the industry. The investment certainly worked very well for Andy Bechtolsheim because his $100,000 investment at that time is likely worth more than $1 billion today. As I mentioned earlier, angel investors usually invest in early-stage companies when a company only has a very limited amount of employees, sales, and funding. Angel investors usually do not invest in companies at a more mature stage, like Uber, Airbnb, Xiaomi, or Didi these days, who have thousands or even tens of thousands of employees and lots of sales and funding. So why do angel investors prefer early-stage companies? The reason is that early-stage companies require much less funding than later-stage companies. For example, Google in 1998 only requires a couple of $1 million of funding. So angel investors like Andy Bechtolsheim were a great fit. However, companies like Uber or Didi or Xiaomi these days requires billions of dollars of funding each time, which can be too much even for extremely successful individuals like Andy Bechtolsheim. So those mature companies tend to go to organizations for funding. For example, VC or venture capital firm, PE or private equity firm, or SWF, sovereign wealth funds. Now, this gives us a good opportunity to discuss our next topic. What is the difference between angel investors and venture capital firms, or VCs? So the similarity between angel investors and VCs is that they both actively invest in startups. However, there are three major differences between them. First, angel investors are individuals, while VCs are structured as a company or firm. Secondly, angel investors almost always invest their own money, while VC firms raise money from other firms or other individuals and then use that money to invest in startups. So another way to put it is VCs have their own investors as well. Lastly, angel investors invest in startups on a part-time basis, while VCs have startup investment as their full-time job. With so much money involved in angel investments, some of you may wonder if there are any regulations around angel investments. Well, there certainly are. For example, in the US and in Canada, angel investors must have assets in the order of millions of dollars, because that will prevent them from going bankrupt in case of a bad investment. However, these regulations do not apply to friends and family members of the entrepreneur, which means an entrepreneur can raise money from their family members or friends regardless of how much asset they have. Finally, it must be said that angel investment is a risky venture. Even though you might end up investing in the next Google or Alibaba, we should not forget that the chance of success for a startup is well below 10%. So angel investors really need to treat an investment like a lottery ticket. There's no guarantee of return, but the return can be pretty high when there's a win. This is especially true for investors who are friends or family members of an entrepreneur, because if they do not understand the risk and end up losing money, you may have to deal with some very awkward holiday dinners. All right, that's all for today's episode about angel investors. I hope you had enjoyed it. Thank you for joining me today, and I hope to see you again next time in the next episode of Tech Time with Bing Dai. Bye-bye.